Welcome back to Investing Talk Podcast.
Today we're looking at Paranovus Entertainment.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. To really understand this company, you have to realize that this isn't the same business it was a year or two ago. It's a completely different animal.
A total pivot.
A total pivot. And that transition resulted in a truly stunning financial turnaround. This is a microcap that executed a dramatic, almost textbook turnaround driven by a complete change in strategy.
It's like they just shed their old skin.
That's a perfect way to put it. They got rid of all the old loss-making parts and focused everything on a new high-growth sector.
And when we look at the numbers, that pivot wasn't. It was on a small step. It was a giant leap.
Oh, absolutely.
Okay, so let's unpack this. The headline numbers for the first half of 2025. We're talking revenue hitting just over $12.4 million.
Right. And you have to compare that to where they were.
Exactly. Compared to the prior year period, that number is an increase of, get this, 18,037%.
It's a staggering figure.
I mean, that kind of percentage, even off a low base, that's not a recovery. That's the rapid scaling of a brand new business model.
Exactly. The percentage is huge. But the critical point for me isn't just the top-line growth, as impressive as it is. It's the profit inflection that came with it.
That's the defining milestone.
It really is. They swung from a pretty substantial net loss, what was it, over $400,000, to actually achieving a net profit of almost $98,000.
Now that swing from deep in the red to black, that's key. But if the starting loss was so high, how do we know that this profit is, sustainable? That it's from real operating leverage and not just some aggressive one-time cost cutting before the report?
That's a fair challenge, and it brings us back to how they did the cleanup. It wasn't just trimming fat.
So what was it?
They systematically exited those structurally loss-making legacy businesses, things like internet information, advertising, their old e-commerce, and even that bizarre automobile sales segment.
Right.
That was surgical. It was removing business lines that just didn't make sense anymore. And that decision is what dramatically improved the quality of these new earnings.
So that cleanup must have freed up capital. Where did they decide to point that new war chest to get this kind of growth? What exactly is the new business?
So the growth is coming really overwhelmingly from their U.S. subsidiaries, and it's hyper-focused on one specific high-velocity ecosystem.
TikTok.
E-commerce product sales and solution services specifically for TikTok. So we're talking branding, consulting, ad production, basically anything a brand needs to actually make money from short-form video on that platform.
And this is where that competitive moat starts to form, isn't it? Because they're not just another digital agency slapping ads on social media.
Not at all. Their whole positioning is highly specialized. It's platform native. Their U.S. units have this deep expertise in how the short-form video algorithms actually work.
They get the creator economics.
And they specialize in conversion optimization that is completely unique to the TikTok platform.
That kind of specialized knowledge has to give them a massive edge against legacy marketers who are still, trying to figure it all out.
It does. And more importantly, it lets them execute what we call the flywheel effect.
Okay, so explain that flywheel mechanism for the listener, because that seems like the integrated model that makes this whole thing sustainable.
Certainly. So Paranovus Entertainment operates on two fronts at the same time. They run direct e-commerce, so they sell products themselves.
Got it.
And they offer marketing and consulting services to other brands. Now, because they're actively selling their own stuff, they're constantly testing creative, targeting, messaging, all in real time.
So if a strategy works for a client,
they can instantly apply that insight to their own products. And conversely, if they discover some new winning approach with their own direct sales, they immediately pass that knowledge on to their consulting clients.
the feedback loop is lightning fast.
Yeah.
It's a self-reinforcing advantage.
Precisely. This integrated approach lets them iterate so quickly, and that continuously improves the return on investment for everyone. It leads to higher margins and, crucially, very sticky client relationships.
So diving into the financials a bit more, the balance sheet seems to be keeping pace with this rapid scaling, which is good to see.
It is. Total assets increased from about $35.5 million in March 2025 to over $37 million by September.
So that suggests real asset growth aligned with the scaling, not just paper shuffling.
That balance sheet growth is a necessary stabilizer, but We have to talk about the capital access. It's a bit of a double-edged sword here. What's fascinating is the sheer size of the potential future dilution risk. The company has an approved $100 million at-the-market program, an ATM, and that's sitting on top of a $200 million shelf registration.
Okay, let's be clear for our listeners. What do an ATM and a shelf registration really mean for the stock price? Because that sounds like a massive overhang of potential shares.
It absolutely creates an overhang. A shelf registration just registers their ability to issue up to $200 million worth of securities later. The ATM is how they can do it. It lets management, well, stealthily, you could say, drip feed shares into the market to raise cash.
So they don't have to announce a big, splashy secondary offering that would tank the stock.
Correct. They can raise cash at the market price whenever they feel the stock is strong enough to absorb it.
So for a microcap that's just turned profitable and needs cash to grow, that's not necessarily a death sentence.
No, it provides flexible, non-debt capital. But it requires very disciplined management. If they use it to fund smart expansion in the U.S., it's a powerful tool. If they issue shares haphazardly, it'll crush the stock.
But the more pressing risk, the one that every investor here has to be watching minute by minute, is the Nasdaq issue.
This is the elephant in the room.
They have that outstanding Nasdaq bid price deficiency notice.
And the clock is ticking. The compliance deadline is set for January 7th, 2026. And for a company like this, that Nasdaq listing isn't just a nice-to-have. It is absolutely essential for keeping institutional investors and just basic liquidity.
And what does that deficiency notice mean practically?
It means the stock has to get back above the $1 minimum bid price and stay there for a sustained period. If they fail, management has to choose.
Delisting or a reverse split?
Delisting, which sends you to the OTC market and kills visibility, or much more likely, a reverse stock split.
And investors generally hate reverse splits. Why is that?
Because it's often a sign that management couldn't fix the fundamental problem. It doesn't create any value. It just reduces the share count to push the price up artificially. And historically, many companies that do a reverse split just end up falling back below $1 anyway.
So that January 7th deadline is looming. It's a huge structural risk that's holding this thing down.
It's exactly what's preventing the stock from trading at a multiple that even remotely reflects 18,000% revenue growth.
So how has the market reacted to this mix of amazing growth, a huge dilution risk, and this pressing Nasdaq problem?
The market is, I'd say, cautiously rewarding the execution. The immediate reaction to the earnings news was very positive. Shares surged about 15.5% right after the announcement.
But even with that pop, the stock is still deeply oversold, isn't it? It's trading way below its 52-week high, and critically, it's still under its 200-day moving average, which is sitting around 97 cents.
Right. So this tells us the recent bounce is just the start of a recovery rally from a point where it was really crushed. Technicians would call this an early base building pattern, a potential reversal.
And what's interesting is that the news about the Nasdaq deficiency back in July didn't cause a massive, sustained sell-off.
Which implies that much of the bad news, that structural risk, might already be priced in. And that allows the good fundamental news to finally start lifting the price.
So if we connect that to who owns the stock?
Well, we see very low institutional penetration, and there's no major insider cluster buying just yet. Now, this lack of big money attention is what I would call bullish optionality.
Explain that, because usually you want big funds in a stock for stability.
You do, eventually. But here's why it's a positive for now. It means that as the turnaround story gains more traction, even small initial allocations from a few new funds could have a huge impact on the price and liquidity.
They don't need a major Wall Street bank to start coverage to move the needle.
Not at all. They just need to keep executing. It's an asymmetric setup. The potential upside, if they solve these risks, just vastly outweighs the remaining downside.
So what are the forward catalysts we should all be watching for over the next few months?
Well, the most immediate one is, of course, that Nasdaq compliance deadline, January 7, 2026. We need to see the stock get above $1 on its own, or if not, an announcement about a reverse stock split. Either way, it resolves the uncertainty.
And there's some corporate action scheduled as well.
Yes. The company has an extraordinary meeting scheduled for its Class B shareholders. This sort of thing could involve changes to the capital structure, maybe governance reforms. It signals that management is focused on long-term health.
And from a fundamental point of view, the market is just waiting for confirmation, right?
Absolutely. The next major catalyst is the full year 2025 report, or maybe the next interim update. Investors need to see that this wasn't a fluke. Can they show sequential revenue growth and keep the profits coming?
They need to prove the durability of the turnaround.
That's what drives multiple expansion. That's what will attract the institutional money we were just talking about.
So if we boil this all down, the core idea here is extreme asymmetry. You have massive operational success on one side, but it's being offset by these significant but solvable structural risks.
That's it in a nutshell. The takeaway thesis is that this is a textbook microcap turnaround. You have proven execution, that incredible growth rate, the swing to profit all in a very hot niche, TikTok e-commerce.
But the stock is still in the bargain bin.
Exactly. It's deeply discounted because of the legacy issues and that listing risk. If management can fix the compliance issue and keep executing, that discount should shrink very, very quickly. And that creates that powerful asymmetric upside we're always looking for.
That's the ultimate question for an investor here, then. The fundamentals are finally validating the pivot, but that structural risk is still looming large.
Which leaves an important question for you, the listener, to think about. How long can a company really maintain 18,000% growth, even off a low base? And what does a normalized, say, high double-digit growth rate look like for a platform-native business like this? The answer to that really determines the true ceiling on this turnaround story.
We hope this analysis gave you a clear picture of Paranovus Entertainment and the massive changes they've made. If you want more analysis into market-moving stories like this, make sure you subscribe to the podcast.